Are you starting your own business? Congratulations. But let me tell you, there's nothing worse than launching your dream business only to get blindsided by tax and financial issues. I've seen it all: unnecessary mistakes, hidden opportunities, and everything in between. Let's make sure that you get it right on day one. In this video, I'm going to be guiding you step by step with the essentials: how to pick the right business structure, saving on taxes, keeping your finances in check, all with insights from my years of experience and seeing other entrepreneurs go through it as well. Hi, I'm Kevin Andrade. I'm a CPA licensed in the state of Maryland, but I work with clients all over the country. With over 10 years of experience, I help small business owners and high W-2 earners legally and proactively save on taxes. If you want tax tips to save your money and grow your wealth, please subscribe. And with that said, let's dive into the video. The first question, and the most common question I get asked: do I need an LLC? First things first, an LLC does not save you in taxes. It's mainly for asset protection. What does that mean? Well, if you want to protect your personal assets from your business assets, an LLC would be the right way to go. So in the event that your business is sued and you have an LLC, your personal assets are protected, such as your home, your auto, your personal bank accounts, all that good stuff. Now, as you start your entrepreneurship journey, an LLC may just only be for asset protection. But as you start growing and profiting more and more, an LLC can actually give you the flexibility to elect to be an S or a C corporation. For example, if you elect to be taxed as an S corp and you're profiting more than $60,000, you will likely start to save a lot. And I'm talking about thousands of dollars in self-employment tax savings. But let's come back to the LLC for a moment. Just a regular single member LLC. You have three options to set up an LLC. Option one would be go with an attorney, which would be my recommendation. Go with the pro that does this every day. You'll have peace of mind and they'll give you guidance on the best way to structure for asset protection. Yes, it's the most expensive route, but it's the safest. Option number two is you can DIY it or do it yourself. There are softwares out there like LegalZoom, Zen Business, or InkFile. And just for the record, I don't recommend them. Similar to TurboTax, garbage in, garbage out. They're self-service softwares. And option number three is literally going to your state website and signing up for an LLC directly with them. Similar to the DIY approach, you don't know what you're doing versus going to a lawyer like the professional. They do multiple every single day. Now, scenarios where you may not need an LLC right away, you can just be a sole proprietorship. And what a sole proprietorship is, simply just you earning self-employed income on the side, being a 1099 contractor, or any other scenario as such. A sole proprietor is great when you're just starting out. That way you don't have to worry about the admin and burden costs of an LLC. I typically recommend a sole proprietorship when you're in an industry with the less risk of you getting in a lawsuit. But if you're in an industry with a high risk of something going wrong, for example, myself, a tax advisory firm, or a trade such as a plumber or electrician, you may need an LLC coming out the gate to protect yourself from liability. Moving on to the next tip, getting an EIN, also known as an employee identification number. What this is a social for your business. Now I'm going to run through two scenarios regarding the sole proprietorship and the LLC. Let's start with the sole proprietorship. So you technically don't need an EIN when you have a sole proprietorship. In the scenario where I recommend it or to consider it is when you want a DBA, also known as a doing business as. So rather than you go out to the public with your personal name trying to collect self-employed income in your personal name, you can do a trade name or a doing business as. It's not a formal entity structure, but in that scenario, you would want to get your own EIN, open up your own business bank account under the business EIN. Now, in the scenario where you're a single member LLC, you 100% need an EIN. That's number one. When you go to the bank to open a business bank account, they're going to ask you for your articles of organization or incorporation and your EIN letter before you even open a business bank account. And getting your EIN number is completely free. As long as you go to the irs.gov website, apply for an EIN, it takes you about 10 to 15 minutes and boom, you're done. One thing to note about the EIN is that once it's created, it's stuck to that specific entity. Let me give you an example. Let's say you're a sole proprietorship. Do a doing business as name, you get an EIN, you open your own business bank account, but down the road, your profits start to grow like crazy and you immediately cross a $60,000 profit benchmark. Well, at that point, you should consider being an S Corp. And in the scenario that you want to be an S Corp, but your previous entity was a sole proprietorship, you actually cannot use the same EIN. You have to open a new EIN in order for you to create an LLC and be an S Corp. Versus if you're an LLC coming out the gate and you want to elect to be an S Corp down the road, you can stay with the same EIN number. So it gives you that flexibility. But again, the main difference between the sole proprietorship and an LLC is admin costs. Now, the next tip that I have for you is opening a business bank account. And this is critical. And I repeat this to my clients multiple times every week. You want to keep your business and your personal assets separate. It's a nightmare when it comes down to bookkeeping and taxes. So just don't. Also, it comes with your asset protection. In the event of a litigation towards your business and they see you have all your business and personal assets separated, it'll come out to your favor. And the reason why is because sometimes new business owners, they mix their business and personal assets together. And when you do so, it's called commingling funds. And when you commingle funds, you actually pierce the corporate veil, which your LLC is rendered useless. So keep your business and your personal funds separate. The next tip that I have for you, which is a very, very common question that I get asked from new business owners, is how do I pay my estimated taxes, or how do I calculate what my estimated taxes should be? So the rule of thumb here is that 20% of your profits should be made to your estimated tax payments every quarter, especially starting out. Now you may say, Kevin, what about tax strategies? I don't want strategies. I don't want to pay taxes. We'll get there. But first, you need to be focused on profits, because if you don't have profits, you don't have a tax liability. And if you don't have a tax liability, you don't really need tax strategies just yet. So rule of thumb, whatever your income is minus your expenses equals your profit. And whatever your profit is, you multiply that by 20%, and that's what you should be sending to the federal government, to the IRS. Now, if you go to the irs.gov website, there's a section for estimated tax payments, and you essentially want to make this 4 times per year. You can do it every month if you want, but 4 times minimum. And there's specific due dates to avoid underpayment penalty. The dates usually don't change, so they are April 15th, June 15th, September 15th, and January 15th of the subsequent year. Now, when it comes to the state varies. It really depends on where you live. I'll use Maryland as an example. Maryland's state tax rate is 6%. So that's where you want to start. 6% of whatever your profits are, and you want to send that same thing on at least quarterly basis 4 times a year to avoid those underpayment penalties. What are underpayment penalties? Well, as an entrepreneur, you are responsible for paying your portion of taxes every month, versus if you worked as an employer, the employer would be responsible for withholding those taxes from you and submitting them to the agencies every 2 weeks or every month. And by not paying the right amount or paying timely, again, April 15th, June 15th, September 15th, January 15th, then the IRS likes to subject you to underpayment penalties. And trust me, your future self will thank you. I'd rather you make those estimated payments throughout the year, and let's say your business grows above $100,000 in profit, and then you engage with a tax advisor. Then at that point, you're looking at implementing strategies to potentially get a refund on tax time. But until you reach that benchmark, you should be making the estimated tax payments. The next point that I have is talking about deducting startup costs. You see, most entrepreneurs are unprofitable in their first year in business, so they'll have losses, right? Well, what if you're really just getting off the ground, you haven't even opened your books for business, not even $1 comes in to the business by the end of the year? Well, then what you can do is still deduct something called startup costs. Now, this applies only for your first year. And startup costs can include things like software, equipment, professional fees, such as legal fees, consulting, and you're able to utilize up to $5,000 in your first year to offset any other ordinary income, even though you've never even earned your first dollar within your business journey. So make sure you're keeping track of everything. You can use QuickBooks, but when you're starting out, I think an Excel spreadsheet is completely fine. Do not rely on just your business or credit card statements. Really track your numbers. The next step I have for you, which comes back to the Excel spreadsheet and is where a lot of new business owners drop the ball, is bookkeeping. You want to make sure your bookkeeping is in order. So what's bookkeeping? Let's talk about it. Bookkeeping is simply a word to say, hey, are you tracking all the money that's coming in and all the money that's going out? Not only are you tracking what type of income's coming in, but what kind of expenses are you incurring? Are you doing advertising expenses, consulting expenses, business meals, travel, supplies and material? All these types of expenses you need to categorize, and you can have a pulse on your business. Where is your money going? A lot of the times, new business owners, they don't even know where their money is going. They simply just look at their business bank account, they see money there, and they're like, okay, I can survive next month. But you really need to know your profitability. How do you not know you're losing or hemorrhaging money month over month? And knowing that information in advance can help you perhaps make strategic business decisions much, much quicker. So as I said before, an Excel spreadsheet is completely fine starting out. And once you want to graduate from the Excel spreadsheet, QuickBooks Online is absolutely fantastic. How it works is you link your business bank account and your business credit cards. It automatically brings in the feed of the transactions, and then you can categorize it in a nice structured way to run reports and financial statements, especially when it comes to taxes or getting loans from the bank. Lastly, talking about documentation. So as a tax professional, when I do your tax returns, I don't need to see receipts and invoices to do so. I need to see your financial records, right? So that Excel spreadsheet or that QuickBooks report. Receipts and invoices, where they come into play is it's really back up to audit protection, because in the event of an audit, they're going to want to see documentation such as itemized receipts and invoices on what expenses you incurred. And no, a credit card statement is not sufficient, because let's say you provide a credit card statement to the IRS and then there's $1,000 for Amazon. The IRS cannot determine whether that was a business purpose or not. So they'll automatically say that's personal and they'll remove that deduction, versus you having that itemized receipt or invoice. You can provide it to the IRS agent and they can go ahead and quickly tell, you purchased a stand-up desk, you purchased a laptop, you purchased some supplies and materials, and these all seem like legitimate business expenses related to your industry. Now, the way you want to save these receipts and invoices are simply in the cloud. You can use Google Drive, OneDrive, iCloud. The whole point of it is to put it somewhere you can set it and forget it, because the IRS likes to audit on a 3-year look back period. Can you remember on this specific date 3 years ago what you did? Probably not. And this is why it's important to have that iCloud service. Make sure you have your audit documentation loaded, set it and forget it. The next tip that I have for you is starting to build business credit. Business credit is fantastic because number one, it helps keeps your expenses separate from your personal stuff. Number two, once you establish business credit, your personal credit won't be affected. And number three, down the line, when your business becomes more profitable, you may want to leverage debt to grow your business, to scale your business, hire that first employee, invest in that software. So starting off and developing that business credit, it's so crucial, especially starting out. You want to look perhaps on a website like NerdWallet, starter business credit cards that have no annual fees, 0% interest rate for at least the first 12 months. That'll get you going. So start small. Don't go straight to the big boys like American Express. You'll get to that eventually. Start with small banks, small credit cards to just start building your business credit. And the next tip I have for you is liability protection. So it's different from asset protection, what I mentioned earlier about the LLC. This is more about the liability of the business, the liability for you. Do you have drafted contracts, drafted engagement letters in writing for your business, for your clients, and not simply just going off a handshake? An engagement letter isn't just a document. It's a shield for your business. In case something goes wrong or goes south very quickly, in the event of a litigation, that engagement letter is going to be huge. It sets expectations and protects you if anything goes wrong. I highly recommend working with a lawyer that perhaps opened up your LLC to help draft up your engagement letter. That investment will be worthwhile and will pay itself back time and time again. Another factor to consider about liability protection is billing and invoices. Are you just collecting payments through your personal Venmo or Zelle? You should consider getting an actual system in place and early. I know you don't want to pay the merchant fees of 3% or whatever the case may be. So you have two options. One, be a legitimate business and incur the merchant fees, or two, you can pass those merchant fees on to your clients. It really depends on how you want to run your business. Another point on billing and invoices is that you want to make it super easy for your clients to pay you. So if your only option is cash, well then so many opportunities could be lost. Who has cash anymore? Everyone pays with credit card. Or if you only accept one form of type of payment, you should also look at various platforms and systems to collect payment from. There's Stripe, there's Business PayPal, Business Venmo. You want to make it super easy to collect payment, to get money. Cash flow is king, especially as you start out in your business. Now, those are all the insights that I have for you in starting your entrepreneurship journey. The first year of business is a huge learning curve, so be patient with yourself. Building a solid foundation will save you a mountain of headaches and expensive mistakes down the line. If you found this video helpful, hit that like button and subscribe for more content. Are you a business owner that has finally reached that milestone of making $100,000 of profit, projected to be almost $250,000? Then it's time to consider tax planning. Click the link in the description to apply to be a client today. Until the next video, take care.